Okay, thanks a lot. We'll try and stay in 15 minutes time. So if we're going a little bit too fast, then just say, hey, 20 minutes is a bit too fast. So we wanted to talk about scaling inside sales profitably. So what's in that word is profitably, which is probably not a word that usually is being used in this whole startup world. But I think someone before mentioned, hey, financing is a thing, and it is a thing, and making sure that you use the cash that you have to grow the fastest and the furthest is super important. And that's what we wanted to talk about today a little bit. Super short. I'm Toni, currently CEO at Falcon. Been there actually for the last 6 years. Had a number of different roles and opportunities there. It's fantastic, and was a lot of fun so far going through that journey.
Yep, and I'm Ola, or Ólafur as I'm normally called here in Copenhagen. And I'm currently the VP of Commercial Operations at Adform, but I spent a lot of time with this guy at Falcon for 5 years almost before that. And and our presentation today about inside sales is going to get a little bit nerdy and operational, so please bear with us if you are dozing off, but I think it has some good learnings, and we're going to look at it from a problematic area we had, so looking at it from, we're not geniuses who had everything figured out from the beginning, but it's actually about learning while you're figuring out problems.
Yeah. Also, we're sometimes referred to as Tola, as a thing. So it's super important to note, we actually don't really have any clue about sales, no clue about SaaS, no clue about operations before we joined. We had some funny other journeys before, but that doesn't matter right now. Super quickly, Falcon.io is we are a B2B SaaS tool. We sell to B2B. We do that over the phone. We do that inside sales. We struggle with that a lot. Neither of us is a sales guy, so we're not the how to get to 100 customers. We are the guys that
how to get to 1 million customers. Yeah.
Yes. So if that leads to some issues kind of relating, then I'm sorry for that. So maybe a little bit of background. We just recently got acquired by Cision, is a US stock, New York City stock listed company, super large. I can't disclose kind of the amount, but we scaled up until then to 30 million euros ARR. So annually recurring at that point was a lot of fun. Our war stories, if you could call it like that, it's more like office stories, I guess. But more the war stories is really about the 10 upwards million. I think this is what we're going to talk about today. I hope you're going to learn a little bit out of this, or can take some of that away. Yes, and that's what it is. First question though, how many people, quick show of hands, who has read those 2 books? Good. If you haven't, you totally should. So we only have like 10-15 minutes. Those 2 books are written by people that actually really know what they're doing. Super helpful. You can't copy paste everything, but it's very helpful. Again, we actually, so when Ulrich started the company, when it was 2012 or something like that, or before that, predictable revenue just came out. That was, the test of the Bible, actually we call it. And then at some point, the HubSpot guy came out with his book, and then we had to kind of change it. And all the New Testament, because something was a bit more than the other. So we didn't quite know what the nerdiness level of the room is, but after kind of following you guys, I think you know all of these different things already. But a super short glossary here. Account executive, closers, SDR, the cold callers, the outbound guys, marketing, inbound. Yeah, we're just going to keep it as that. It's way more complex and everything, but let's just keep it at that. Also, a quick thing, CAC, customer acquisition costs, and this is all costs related to acquiring a customer, basically all sales and marketing. Payback, super important. Who knows what payback means? Okay, Jakob, I see your hand up, that's good. So payback means basically you have, let's say, €1 million, let's say it's €1 million to acquire customers in a given time span, let's say a quarter. And out of that, you get not a million customers, a million, euros. So I have a million. Now I'm getting confused actually. So I have CAC, 1 million euros for sales and marketing, and you have that in a given quarter. And from that, you want to acquire, let's say, 100,000 euros of MRR. MRR is probably a clear thing for everyone, like monthly recurring revenue. What payback means is how much time do you actually need to recoup the customer acquisition cost that you spent to get it back in month. And the average, not the average, kind of the good best practice is 12 to 15 or something.
Yeah, and it's kind of an efficiency thing. So it's kind of how efficiently can you go out and buy money, and how fast can you actually return that money and reinvest it into new CAC. And that's why it's really important, because it just shows that you can really effectively take the cash that you acquire and put it back into the engine and then scale as you go along.
We're going to say payback and CAC a bunch of times. And then there's just the normal stuff: CVR, conversion rate, ASP, average sales price, and OP is opportunity. Many other people use MQLs, SQLs, trials, signups, whatever metric they use in order to kind of go a little bit higher up funnel instead of only the closed business. How are we doing in time actually?
6 minutes so far.
Oh, that's actually good. Okay. The story today is about 2016 and the second quarter of that. What happened there was everything was going phenomenal, as it obviously does in those venture capital funded companies. Series A of 6 million euros in mid 13. We were scaling sales and marketing quite a lot. So this is, by the way, the FTE of only the sales and marketing team. So we're talking 100 people at this point. Series B, we added lots of VPs with a huge product launch. Everything was rocket ship. Everything was going fantastic. And then the problem happened. And that's what we're going to talk about a little bit today, because Ola and I will learn a bunch from that, and was a super important experience not only for us but also for the company. And we want to try and make sure that some of that can be maybe translated, and some of those mistakes don't need to be made again. Right? Yeah. So that's the usual problem in sales, right? We're not hitting target, but we already paid all of those salaries. And the thing is here, what happened in Q2 16 is, and those are roughly correct numbers, by the way. We had a total customer acquisition cost, again, as sales and marketing, of 2 million euros in that quarter. And those 2 million euros only produced 100,000 euros in MRR. We have annual contracts, so it's really 1.2 million, but it doesn't matter right now. And really the payback is 20. So what happens when you have a payback of 20 is that really bad. We went from 13 to 20 in like 1 quarter. We had a lot of cash still from the Series B, but we were kind of burning through this pretty fast. And if you don't recoup the money that you spend on customer acquisition because you didn't acquire those customers, it's going to cost you a lot of money really quickly. And it's not like we were like, bankrupt tomorrow, but there was, let's just say the burn rate was it's not great.
Scary.
Yeah. That's kind of the background of that. Do you want to add anything to the kind of?
No, but I think this is sort of the wake-up moment for the company, right? So there was a phone call from the CEO, I think, to Toni at the time to say, you guys need to go into a room and figure some shit out and come out with a solution tomorrow. Yeah.
That's kind of how it went.
Pardon my French.
And again, right, we really didn't have much clue as well, right? So this was going into a room, I think it was over a weekend, kind of looking at all kinds of numbers, and then, things were figured out, and now it's kind of what we actually did figure out. It's 2 simple insights, because we were super conscious of the time, and Ola's going to talk us through some of the insights and how they're connected and how we actually use them in the end.
Yeah. Well, so a payback of 20, all companies pretty much calculate their paybacks, and it's a great way to kind of figure out how effective your business is, right? But, how do you fix a 20 payback? You need to understand what's contributing to that payback being 20. Where are the things going wrong? And a payback being really high is a cost problem. It's a cost efficiency problem. You're not able to produce revenue at an effective rate. So the first thing you have to do is kind of break the number down into different units or viewing it from different angles. And one of them is to basically start by splitting them by region and by channel, so that you can actually start to see what is contributing the most to you having a super high payback. And so we did that, and what that basically produced is that we first saw it from a channel perspective on a global scale, and we could basically see that our payback was, I think it was 26.5-ish, something like that, for the marketing channel as a whole.
The marketing guys.
Yeah, sorry about that. It's not to, denigrate marketing or anything, it just means for us at that time, that's where we were hemorrhaging money, right? And then on the other side of things, you have the outbound team, which was actually producing a 13 payback, which was a fairly okay payback at the time. But actually the blended average of this ended up being 20 payback because of the way we were sort of scaling money. You also look at it from a regional level. Obviously we're showing a very simplistic picture here. There's a lot of data behind this stuff. But also you can just see that within the US, we were inefficient. I mean, it was a growing market for us. We were investing in the market, so there's some explanations to that. And in EMEA, you can actually see that we were having a 11 payback on outbound and a fairly, so we had a fairly good model. We had some good pockets of, spend where we're actually very effective. And once we understood that, we really needed to figure out how do we fix this. And looking at that very simplistically, you kind of, if you flip to the next one, you kind of have to just question everything that goes above 12 in payback. So, you have to really look at this, and marketing as a whole, and you need to effectively cut this to become effective again. And to cut this, it's obviously different marketing channels, so you're going to have different paybacks on Google or on Facebook or on email. So there's a lot of nuances to this graph, right? But you really need to start cutting everything that's not bringing you in line to a 12 payback. And then you look the same on the market, so you start redistributing money between the regions to get a better effectiveness rate of how do you spend the next incremental dollar is really the core question that you're trying to answer. So you're always just having these channels and these markets compete against each other for who's the most effective, that's the one who gets the money. Until they become less effective, then another region gets the money or another channel gets the money. So you basically are sort of racehorsing and you're always just betting on the winning horse.
Maybe, so for us it was those two predominant channels, let's say inbound and outbound, and the predominant regions, US and EMEA. For anyone else, it might be products, it might be different regions, it might be, instead of marketing, it might be partners or other channels. I mean, there's many different ways, and the importance is you kind of double click on the payback, once you get there, realize, oh geez, something isn't quite right here, and then you need to double click again to then see, okay, so actually EMEA outbound is really going well, US outbound kinda, but it is a strategic market, so we need to invest a little bit more. But marketing as a whole, didn't really show a different picture when you kind of see it regionally, right? This is a little bit how this really transpired.
Yeah, and I think then, so basically now you have, let's say, imagine you've freed up a lot of cash. You've decided to cut many channels, much marketing spend, headcounts, the whole thing, right? But if we were doing our jobs, we're the growth guys, right? If we just cut costs, that's fantastic and everything, but if you cut the growth rate at the same time, you've achieved nothing, right? You can do then effective growth, but it's going to be very small growth. So you actually need to understand how to take all those savings and redeploy it and deploy it in a different way where it actually yields a better payback. So then the engine can still keep growing at an exponential rate, but you need to figure out how to do that. And yeah, I mean, very simplistically, and I think most people should try to think of sales like this, which is basically that the number of opportunities you have, the conversion rate of those opportunities, the average selling price of those opportunities, and how long it takes, or velocity, this is going to dictate how you make money in the end, or MRR. But then we have, let's say, a ton of money to spend, and then you have to think about, well, okay, where can we spend it in this equation? And that's where we sort of look at the picture from a different angle, which is basically that, conversion rate is a fairly stable thing. You can hire sales coaches, you can get your people to be better, right? But it's a slow thing, it's not something you can really influence over a short period of time. You can't hire 10 more account executives and get a better CVR. This is a formula that is there. On the ASP, this is a market dynamic number. You know, how much you can sell for is pretty much what you're competing against in the market, competitiveness, there's a lot of stuff on that.
And many things have changed that, but just not tomorrow, right? Yes, build product, sure, and get better, sales rates, but just not tomorrow.
Yeah, and that's really the thing, because you need to deploy cash fast, so to keep scaling the engine, right? And the opportunities, even though the opportunity per rep is not something you can also maybe change, you can't change that over a period of time, but if you hire more reps, you will actually get more opportunities. Given that you will have the same efficiencies, you will have a very predictable way to buy opportunities. And that kind of brings the equation down to a very simple fact, which is that opportunities equals revenue. I mean, it's a bit more complicated, but that's kind of what it is.
It's actually not more complicated. That's actually what it is.
Okay. But, and once you understand this dynamic, it's really about figuring out that buying opportunities is kind of, if you can buy cheap opportunities, you can really figure out how to buy the cheapest revenue. So that's really fundamentally what it is. And then you kind of go back into the numbers and you break down, you do some complicated math to figure out cost of opportunities between channels. Let's not get into that. But then you kind of, on a very fundamental level, figure out how much does an opportunity cost. And once you do that, and there you see basically that outbound, fairly consistently across all the regions, is sort of 1/3, 1/4 the cost of an inbound opportunity being generated. And it's pretty clear what you should be betting on. And you should probably be taking all of this cash you're spending on this and actually throwing more at this.
And again, it's more complicated, right? So your marketing opportunities might convert a little bit better than the outbound ones, right? But largely speaking, at that point, we were basically able to assume every opportunity is created equal, right?
Yeah.
And will also behave like that.
And I think once you kind of have these two core insights, and this is what we had to do, you've got to get pretty ruthless about implementing those two insights.
So, and at that time, that was not our call, but it was part of our recommendation. So we actually, it was really shitty time, really shitty time. So lots of unhappy stuff happened at the time, but it was the right thing after all. We basically had to cut marketing by half based on the numbers that we saw before. We actually ended up reducing the amount of account executives to the minimum because we knew, hey, account executive can take so many opportunities. Wait a minute, we actually don't need so many account executives. That had an impact on the account executive leadership and an impact on most kind of sales support, sales ops, not us, roles. And we took all of that money and we basically put it into SDRs, all of it. Because it's also super repeatable, and then there's lots of, hey, how do you scale this? Well, you hire more people. It's pretty straightforward in this, right? So we went basically then back to a 14 payback in Q3. We need to hurry up a little bit. That's why.
Yeah, but just to kind of bring it back, the numbers we were talking about before, the 20 payback and all the previous numbers, were in Q2 of 16. So we're talking within a span of 3 months, you can absolutely completely turn around the engine if you figure out what is the thing that's scaling effectively for your business.
Yes. And today, we still live by those rules, actually. Everything in sales and marketing is really judged by its payback. Everything. I just hired a VP channel and partners. The calculation that I made was like, what's his payback gonna be, right? So it's super important if you want to make an investment like this. And the next thing, really the whole company rallies behind our and this is Ulrich, the CEO word, relentless opportunity production. By now we have around 60 SDRs. We also got marketing back to a competing payback, so it's not we didn't slash it completely, it's kind of just balanced out nicely now. And we actually really have like all those dashboards and really it's opportunity, right? And that helped us a lot to grow a bunch. And there's a little bit, I don't know, it's, yes it worked, that's what it says, and that's it. Thanks.